Welcome to the podcast where we discuss all matters financial planning and investing. This content contains general information only and may not be relevant to everyone. Please contact our office to make sure and determine if this is relevant for you. Share market meltdowns and how you handle them. And really, the markets have been interesting over the last couple of weeks, and it really tests us how we handle our emotions and make the right decisions at the right time, which is extremely important if you're invested into the share market. And that can be through your superannuation, it could be investments outside of superannuations, and really just investments in general. How you react to certain situation is really key, and really getting an understanding of how you actually can, there's little things that you can do to make sure that you're making the right moves and making the right decisions as you go along. And over time, it gets easier and never gets extremely comfortable. So when the markets go down, especially when they go down really fast, it's one of those things that happen about 1 in every 4 years. So if you go over history, this is something that's happened continuously and will continuously happen. Last year, we were up in the 20% and for a lot of the risk profiles. And what I found is that, and the previous year was similar. And when those things happen, there's something going to happen. You just don't know when. And it could be the market could go up another 20% before one of those things happen. But on average, it happens about once every 4 years. And so really 75% of the time, the markets are going up. So we can get a false sense of safety at times. And because what actually happens is the market, I always talk about the market step up. So they go up slowly, and there are some big days that the market can move, but nothing like when the market goes down. So when the markets go down, and you know how they have been at the moment, they catch the elevator down, and also they do what you call gap down. So when the markets are opening, they're already down so far, they're trading at really levels that really push the market down, and it increases fear in the market. You have greed in the market when markets are going up, and the FOMO, the fear of missing out, and the markets move on their way. But when the markets are going down, it really instills that fear, and how you handle that is really important over time. So how you actually plan to have your money invested, this shouldn't be a surprise to yourself that these things are happening. And I know, like a lot of my clients, I take them through a risk profile, and at the time we go through it and everything's quite nice, but that's when most people are not under pressure. But once you are under pressure, it'll feel a little bit different, and depending on how much money you've got invested, everyone will deal with that a little bit differently. But getting your risk profile right when you're investing is extremely important. And when the markets have gone down percent, if you're in a growth risk profile, you didn't go down 100%. And also that your portfolio will be providing some income as well. So generally that's going to be around 3 or 4% over the year. And at the worst particular stage, the market can drop any range in any given year. The market will range 20 to 25% from high to low. And some years there's going to be more, but in any given time, let's say this month, for example, it feels really bad, but then generally when it works itself out over the next 12 months, I'm not sure what I was really worried about. And over 20 or 30 years, you'll be through lots of cycles and at different levels. If you've got $100,000 invested versus $2 million invested, it'll feel totally different how much the market moves. But the reality is how you actually react and stay with your financial plan, because that will actually pull you through. So generally when you create plans, they work. It's the people or the decisions that we can make at different times will stop them from working and making the wrong decision. So one of the things I always talk about when people start investing as well, generally we're doing what's called dollar cost averaging into the market. So we're continuously buying, especially if it's superannuation, for argument's sake, your employer's putting money in or you're putting money in, and the investments generate some income. So we keep buying into the market that way. And over time, you're getting the average price in the market. So when the markets go up, you're buying. When the markets go down, you're buying. And you're just continuously buying over time. And it becomes a beast of a thing. It just starts generating a lot of money on itself. So really focusing on that. And there is times when you sell a business or you make some money from different things and you put some lump sums in. It's one of those things that it happens. But if you go down the track in 10 or 20 years, it'll just be a blimp in the road. And at the moment, it might feel, if you put some money in the markets, some more capital in the markets, it'll feel a bit more uncomfortable at this stage, but it will work itself out. And when you keep buying and those investments generate income, and then you keep compounding over time, it will sort itself out. Really, I always, when someone will come to me and say, you know what, Dave, I want to put $1 million into the share market, I'm like, have you ever really done that before? Because it could drop 200 grand tomorrow. We just don't know what could happen. And that's the nature of the beast. Unfortunately, it does have its positive and it has its negatives. And we've got to be able to handle that emotional intelligence insurance to be able to make the right decisions, because you can sell your shares or your super or change the investments that they're in pretty fast. And that's a good and bad thing for some people. So really I always talk about you can only control what you can control. So you can't control external forces and you can't control what the market's going to do. So making sure that you have gone into the investment, and it's a long-term game. Investing into the share market is never short-term. It's if you're in there for a quick minute or a year or something like that, it's just a short period of time that's got danger written all over it. My advice to everyone who's in the share market, stick with your plans. Whatever you planned, and that'll shown over history and over time, that would have worked. And getting some support on your side, if you've got a financial planner or you're looking for a financial planner, make sure you've got people that are supporting you through that, or investment professionals. You won't hear any of them screaming sell. You will hear them being really calm about, well, in the market, it's creating a unique buying opportunity. If we have surplus money, we may be able to put that in. Obviously, all that type of things have risk, but how you respond will really determine over the next 3 to 4 to 5 years how your portfolio's overall gone. And the people that always tell me they lost money in the share market or lost money in the property market or wherever it may be, generally it comes down to selling at the wrong time through panic or fear and not being able to go back into that. So if you're feeling like that and really uncomfortable, hopefully you can ride this one out and then maybe change your scenario as you go down the track. But once you change your scenario, you really need to change and stay in that risk profile if you sold out of where you are today. But just really getting some support around you. Get through the first one. It will end and things will happen. And whether it's Trump, whether it's the GFC, whether it's the next thing, and I promise you, there will be a next thing. It's one of those things, especially in the share market, that we need to ride out and over time. And depending if you need the money or not, obviously, if you need the money within the next year or two, obviously, it's very important that you probably weren't in this scenario. But if your money, you don't need it for 3, 4, 5, 10 years, obviously, this is a bit of a painful period in the road, and it will go and things will turn around, and then you'll be glad that you stuck through it and controlled your emotions and make sure that you're not making decisions that can really badly affect you for now. Just stick with it. Everything will turn. Control your emotions, and I really look forward to talking with you soon.